Hello, friends. It's Cynthia Meyer with Real Life Planning, and this is the Real Life Planning Podcast. And today I have a really special guest, John Bernstein from Bernstein Financial Advisory, and a member of my coaching circle or mastermind group, is here today to talk to us about risk parity. It's an important conversation, and there are a lot of good takeaways, so I hope you'll stay with us. Good morning, John. How are you?
Good morning, Cynthia. I'm very well. How are you?
Good. Thank you for being up early this morning to come on the Real Life Planning Podcast and tell us a little bit about your story. What's important to know about you?
Let's see. I've been in the investment business for a very long time. I don't know if I should admit that or not, but I began my career in the investment business in 1987, about 9 months before the market crash occurred back in that year. And I had a very long career with a Minneapolis-based institutional investment manager. And in 2016, as my eldest, I have 4 kids. My eldest daughter was graduating high school. And I decided I wanted to spend a little bit more time with them as they were starting to grow up quickly, or at least
Mhm.
it felt like that. So I left my job and spent some time with them. And when I started interviewing to go back to work, I had an informational interview with somebody who was similar to me, a father whose kids were a little bit older, who had similar work experience. And during the interview, he said to me, "You ought to start your own business." That's what I did 10 years ago. And I went home and I thought about it for about 24 hours and I never really looked back after that.
And that's wonderful. And so now you're working with clients, you're helping your colleagues in our mastermind group. What do you focus on in your firm?
I try to make investing simple, both in the way I communicate it and what we do. This is an industry that has a tendency to make things more complicated than they need to be. I think there's a variety of reasons for that, which maybe aren't very important for us to discuss. But the reality is, I think that's the case. And there's nothing about this that should be a black box. I like to say when my clients go to a cocktail party and somebody says to them, "What's your advisor doing for you?" They can tell them. They don't have to say, "I'm not really sure, but it seems to be working," or "I'm not really sure, it doesn't seem to be working."
Yeah, some people just say, "Oh, I don't know. They just tell me what to do." That isn't necessarily a great recipe for success.
Right. At the same time, it reminds me of the old expression, if somebody asks you the time, don't tell them how to make a watch. Truth of that is it's my job to figure out which of my clients, when they ask me the time, in fact, only want to be told what time it is,
Mhm.
and which clients actually want to hear how you make a watch.
Do you have a preference to working with people that want to understand how things tick, or for somebody who just wants to know the simple answer to the question, okay, can I retire? Yes or no?
Not necessarily. I find that all of my clients at least want to hear the story. They'd like to have a basic understanding of what the
Mhm.
strategy is at least once. Maybe once we've done that initially, at that point, they trust me and they don't want to
Mhm.
know the details anymore. And that's fine if that's who they are. If it's somebody that wants to discuss the hows and the whys, I'm happy to do that. And that can be kind of fun.
So, John, you have a very clearly defined investment strategy in your firm. Can you talk a little bit about this defined strategy that you have and how people can think about it in terms of an investing paradigm?
Sure. I'd say that the basic root of it is trying to get a well balanced, diversified portfolio. There's a lot of ways to think about that. Typically, when you hear people in the industry talking about a diversified, balanced portfolio, they're talking about the dollars. The classic example is what's called a 60% stock, 40% bond portfolio. And when somebody says that, they're talking about 60% of the dollars in the portfolio being in stocks and 40% of the dollars being in bonds. One of the problems with that is that doesn't focus on risk, which is the piece of a portfolio that you really ought to be focusing on diversifying. In a 60/40 stock bond portfolio, as an example, when you do that by dollars, the risk is still about 90% in stocks in a portfolio like that. And I think most people don't realize that. And the reason for that is that stocks are about 5 times as risky as bonds. So what we try to do is focus on the risk that each asset has and distribute the risk across all of the possible investment environments that exist in the world, which is basically four. And when you do that, you don't have to guess about when inflation is going to be difficult or when inflation is going to be a tailwind and dropping. At the same time, you don't have to worry about whether the economy is going to grow next year or we're headed into a recession. You build a portfolio that can withstand all of those things because the risk is equal between all of those environments.
That's a risk parity approach. And do you have a name for how you describe how you do it in your firm?
Yeah. So the generic term for this is risk parity,
Mm.
which literally means equal risk between
Mhm.
these different environments. It was developed about 20 to 30 years ago. And largely, it was developed for institutional clients. And part of the reason for that is that to make this work with true equal risk in the four different environments, you have to use leverage and you have to borrow money in to buy some of these investments. And I
Which
felt
is
that
the average person is not well suited to do.
that's right.
Yeah.
And because my clients are individuals, I didn't feel like that was an appropriate
Mhm.
strategy. The generic term for what I do, I call modified risk parity. So we get that risk distributed as well as we can. It's not actually perfectly equal. It's not 25% in all four boxes, but it's much better than a 100% stock portfolio. And it's much better than a 60-40 stock bond portfolio.
What are the four environments for those people that are familiar with this kind of investment research?
Yeah, it's pretty easy. It's rising growth when the economy is strong. It's falling growth when the economy is weak,
Mhm.
rising inflation, and it's falling inflation. If you think about those four boxes, there's two of those that stocks do well in, and that's rising growth and falling inflation.
And where do you think we are right now?
It's a great question. And
Maybe we should just take it straight to Bloomberg, right? Yeah.
so part of the answer is you can be in more than one box at the same time. We're in a rising growth environment at the moment. We're also in a rising inflation environment. And by the same token, each asset doesn't necessarily belong in a single box. Sometimes they're distributed partially in several of these different environments. And so that's taken into account when we look at the risk that each of these assets contributes to the portfolio. Gold performs in a rising growth environment. It also performs well in a rising inflation environment. It can also perform well in a falling growth environment.
Mhm. That's really interesting. And what about direct ownership of real estate? As you know, I work mostly with real estate investors and own many rental properties myself. Well, where does that fit in residential real estate?
Right. So in the work that I do, I don't include that. That is absolutely a real asset that would be a good inflation hedge and would typically work well in a rising growth environment and also a rising inflation environment.
Huh, that's really interesting. What can the DIY investor that's listening, and again, we're not going to give people investment advice here. We would certainly encourage you to make your own wise and comfortable decisions in consultation with your financial advisor. What are some general principles that somebody who's interested in learning more about this, what should they be reading, thinking, doing?
A great place to start is go on the internet and Google risk parity. There are some white papers out there about this, a couple of which are written in reasonably plain English. There's one firm in particular that kind of pioneered this idea starting back in the 1990s. If you Google it, you should find that firm. It's called Bridgewater. Pretty well known. It's a highly successful firm. Its leader is a guy named Ray Dalio who has,
It's got the best-selling book out right now, I think.
yeah, and he's
Yeah.
had several
Mhm.
books. Starting in the early 2000s, as it became clear that this strategy actually worked, the rest of the investment industry adapted it. Bridgewater is a good source of information on it. There's some stuff that's come out after that where people have made some adaptations to the strategy. Some of those have been good adaptations, some not so much.
For those people who are listening who aren't as familiar with modern portfolio theory, for example, or how investment professionals think about constructing a portfolio of assets for a client, tell me, do I have this right, John, that basically your budget is for risk and not for dollars? And by risk, you mean volatility, right? And you mean the possibility of losing money, right? The possibility on the downside volatility, because we all love the upside volatility. If we do better than expected, which is also a function of risk, we're generally pretty happy about it, right?
That's right. And
Yeah.
we've come through an incredibly unusual period in financial markets. From 2009 up until the pandemic hit in March of 2020, we had the longest bull run since people have been tracking that kind of
Yeah.
information. The 2020 market correction was so quick, that was under 6 months, that you could argue that until this year, we were in a bull market. That's an unprecedentedly long bull market. And I think it's one of the side effects of that is people think that's normal. It's not normal.
Mm.
And in fact, there's equal and maybe better chance that we could go into a period where the exact opposite of that occurs and stocks underperform for an extended period of time. And that's what this portfolio is protecting against.
Mhm. I think there was a McKinsey study in maybe 2016 that predicted the same thing, that real stock returns over the next 20 years would be lower on the average than real stock returns in the 20 years in the rearview mirror. Now, as financial planners and investment managers, we always encourage people to think about what they're doing in connection to their goals, as opposed to watching the financial theater of the markets every day, because you could just stare at a screen and your net worth changes every second. What guidance would you give people in terms of their own behavior right now if they're feeling worried or anxious? For many younger folks who are listening, they've literally, other than the short period during COVID, they've never seen their portfolios go down for any sustained period of time. The first time that happens, it can wig you out, right? Like, people may be taking more risk, meaning more appetite for possible loss than they are really truly comfortable with.
Yeah, I guess I'd start with don't try to time the markets. Professionals in this industry spend lifetimes doing it, and for the most part, are
And
not,
mostly can't time the market, right?
they're not successful at that.
Yeah.
There's enough people doing it that there's somebody that always, in fact, does it in each environment. But they got lucky, right? The same people don't repeat that. There was a woman that called the 1987 stock market crash way back then. And she was all over the financial news for several years after that because she was viewed as being this guru, but she never made another call like that again. There's lots of examples of that through this industry. It's the old
Mhm.
axiom, better to be lucky than smart. So don't time the markets. It's not a strategy that works very well. And that's what the Better Balanced Portfolio tries to do. Instead of trying to guess when we're going to shift from falling growth to rising growth or falling inflation to rising inflation, we distribute the risk as evenly as possible between all of those possible scenarios and expect that the portfolio will hit singles all of the time instead of reaching for the fences and trying to time one of those shifts between one
Mhm.
of those scenarios.
Yeah. I think that's really interesting to me as an investment philosophy, as somebody who has their CFA charter and by no means an investment expert. There are lots of people much smarter than me in this area. The idea that you can take an institutional approach to your personal portfolio really can benefit all of us. You're not just investing in something because you saw it on CNBC.
Exactly. And this is a pretty simple concept, but its execution is a little bit more complicated. That's
Mhm.
where my expertise comes in.
Mhm.
One of the things I try to do is do this in a way that is cost efficient and tax efficient as possible.
Mhm. Always helpful. Right. Tax optimization. So, getting back to what people can do now in this environment, we're not trying to give you all investment advice, where we're trying to talk about foundational principles for how to think about being an investor. Is there anything else that you would say to people listening right now? But you said don't time the market, right? Anything else that we should be thinking about?
Yeah, I think that the number one piece of advice, I'm always struck by the financial press. I think it doesn't always serve the public really well. What commonly happens when we get into volatile markets like this is articles come out about what you should be doing in your portfolio to protect from whatever it is that's going on in the
Yeah,
market.
the inflation or
Right.
taxes or stock market crash or whatever.
Right.
Yeah,
By the
even though
time,
we're not in a crash, since we're in a
right.
falling market. Yeah.
The problem is that by the time those articles come out, it's too late, right? The move has occurred, or at least a significant portion of that move has occurred. So the idea that after we've had 4 months of really strong inflation, you're going to now try to position your portfolio to protect against inflation, you've missed that time has passed. So my point is that the best thing to do is to sit down with a professional who can help you and think about your portfolio for the long term, what your own goals are, not what you think the market's going to do next year or in 5 years, but what are your financial goals? What are your life goals? And how do you construct your portfolio to match those? As an example, if you think you're going to be buying a house in 5 years and there's a portion of your portfolio that you might need to access for a down payment, that's money that probably needs to be invested differently than
That's
money
right.
that's been there for 30 years.
You take a lower risk strategy with that money.
So when you find your dream house, you're not selling stocks at their lows because you really
Mhm.
need that money for the down payment. Instead, that money was put into something that's safer, as you just said, less volatile, so that you can take that money out and not feel bad that you've made a bad investment decision in doing so.
I'm talking to a lot of folks who have some relatively short to intermediate term goal that are worrying about loss of purchasing power, where normally you might leave something sitting in cash, for example, and then weighing the pros and cons of, is it a cash only strategy? Is it a capital preservation strategy? There's a lot of discussion in the financial community at large about what folks should be doing in that right now. And I don't know that we're necessarily going to get into that, but people are thinking about it.
For sure. Yes. There is one, I'll just mention briefly, there is one asset that we use in the Better Balanced portfolio that would lend itself pretty well to that. And that's US government inflation index bond.
So can I change the subject here, John, to something that I'm guessing most people don't know about you, which is that you have a very long exercise streak. This says a lot of important things about you. On your website, there's this really cool video montage of you doing a gazillion different kinds of exercises. Talk to us about that. How long is your streak? What made you start doing it? How have you been able to keep it going?
Yeah, it's been an interesting experience for me. I was an early adopter of Peloton before everybody heard all about it, and they had controversial commercials and all of that stuff. I bought one of the bikes back in 2014, and they had a Facebook group, and I joined that group. There was a subgroup that came out of that, and the goal of the group was to exercise for 100 days in a row. And I joined that group and decided to do that. At that time, when I was considering whether or not to do it, I thought, I wonder if this is really a smart idea. I have a personal trainer that I use. I talked to him about it. I'm a guy in my 50s, and I thought, if you do the same thing over and over every single day and don't give your body a rest, that's a good recipe for repetitive use injury. So I talked to him about it, and he said, if you're careful about how you do that and you have enough different activities that you do, you can always have some part of your body resting. You're not going full speed every single day. And so that's what I did. It forced me to actually expand the types of exercise that I do. I picked up boxing back in 2016 when I joined this group. And I still do that today, along with a few other things. So if you think about exercise generally, there's three big categories: aerobics, strength, and flexibility. My activities span across all three of those things. If I ride the bike one day, the next day, maybe I do an upper body strength workout. I always like to mention that because this isn't something that's overly obsessive where it's actually detrimental to my health and my body.
Heavy cardio every single day without rest.
Exactly. I think we tend to do that with things like exercise and challenges for the sake of the challenge, which here and there, that's fine to do that kind of thing. But the truth is, usually those types of things aren't great for your body, those kinds of extreme challenges. So anyway, I joined this group, and about 50 days into it, I realized that this was actually becoming pretty easy. It was starting to become a habit, not much different than waking up each morning and brushing my teeth. I wondered whether I
I'm
could
having coffee.
Yeah, cheers to that. I wondered whether I could go for a full year. And so that was the next goal. And here we are, approaching 6.5 years now. This streak started in March of 2016, and it's still going. And it's funny, people are often very impressed by it. At this point, it doesn't feel impressive to me because, like I said, it's become second nature. It's as if somebody was impressed that I wake up every morning and brush my teeth. It's just something
It's part of who you are. It's like how John Bernstein is in the world.
Yeah. And so what I stumbled on with this, and I don't think it would necessarily work for everybody, but I think there's a lot of people that would work for, is that we all have behavioral stuff that we tend to avoid. We don't like doing, whether it's exercise or saving money, whatever it is. If you create a streak
Filing.
like
I hate filing. Yeah.
there you go. If you create a streak like this, it can help motivate you to do the things in life that you don't necessarily want to do when you wake up every day. Now, when I wake up in the morning, the question for me is, am I going to work out today, or am I going to break a 6.5 year streak of working out every day?
What is the best piece of advice that you've ever received,
I think I would say to stay flexible.
both in your investing philosophy and in your exercise program?
Personal life. Life is always going to throw curveballs at you. And the more flexible you can remain about that, the easier it is to navigate through it all.
That is wise. That is wise. Thank you very much for joining me this morning on the Real Life Planning Podcast. And where can people find you online?
Thank you. It's been a pleasure to be here. The website for Bernstein Financial Advisory is bernsteinfinance, all one word.com.
Okay. Are you on social? Any particular social platforms that you like to
I
use?
am. You can find me on LinkedIn, Facebook, and Instagram.
Excellent. All right. Wow. Cheers. Thank you.
Cheers. Thank you.